The topic for today is the bank rate versus open market operation. I will suggest you first go and study my separate article on bank rate and the separate on open market operation, and then come to the topic bank rate versus open market operation. See, bank rate and open market operation both are quantitative credit control methods. Very simple. They both are in the list of our credit control methods in the quantitative list. It is believed that open market operations are suited better to influence the market trends directly. Now, you want to capture the market directly, then open market operations are better in comparison to bank rate. In the bank rate policy, the central bank has to wait for the market to react. It's a little slow process. The central bank has to wait for the reaction of markets to respond to its change in the policy. The efficiency of bank rate depends on its indirect influence in the market trends through the changes in the money rates. This bank rate efficiency has an indirect impact on the market, right? You and the central bank has to wait and watch for the market. How does it react to the changes in the bank rate? But open market operation, it has direct and immediate effect on the volume of money and the volume of credit. When the central bank comes in the market to purchase and sell securities, so it has immediate immediate effect on the volume of money and the volume of credit. But in the bank rate, it's a comparatively a slower process. So, open market operation proves its superiority over the bank rate as compared to the effectiveness and the speed, both the things. Next slide, we discuss the points regarding the superiority of open market operation as to what are the points, what are the bases on which we consider OMO as a little superior to the bank rate. Now, the first point is the direct way of controlling credit. Open market operations are the direct way how you can control the credit, but the initiative lies in the hands of the monetary authority. So whatever will be the direct way to control it, it would be a little more superior and effective. On the counterpart, bank rate, it's an indirect way of controlling credit. We are not undermining the effectiveness, right, or the degree of bank rate, how it can affect, but it's a little indirect. This is what we are trying to say. It is an indirect way of controlling credit. The initiative here lies with the commercial banks. Here it is with the monetary authority, and here is the commercial banks. Second point is direct influence on the long-term interest rate. OMO has a direct influence on the interest rates in the long term, but bank rate has the direct influence on the short-term interest rates. Directly, what will be affected by the bank rate is the interest rate on the short term. The long-term interest rates by the bank rate, they are affected only indirectly. Now, no doubt we have discussed the superiority of OMO, but we equally consider that bank rate and open market operations are used together. See, to achieve effective results, the bank rate and open market operations are used together, not separately. They work as a team. Bank rate and open market operation may not produce desired results when used independently. So you cannot bank upon one of these credit control measures. You have to use them together in conjunction to achieve a better goal. See, the economist Hawthorne believes that open market operation should be employed in conjunction with the bank rate to get the desired result. As I just stated, that both of them should go hand in hand and will be able to achieve the better desired results. But there's a counter view as well. Keynes believes that open market operations need not be supplemented by the bank rate policy to get the desired results. He believes that OMO doesn't need to walk hand in hand with the bank rate to achieve your desired aim. He further holds the view that open market operation may be employed independently, provided they are supplemented by suitable fiscal policies. So he has a different viewpoint that you can use OMO independently, but you have to assist them by suitable fiscal policies. Further, See, open market operations are used to prepare the ground for a change in the bank rate. So we consider it as the first step. OMO prepares the basis. When you are about to change the bank rate, the ground floor is prepared by the OMO. Apart from the above, what we discussed, open market operations are used to create cheap money conditions on the grounds of public policy. The money market, the conditions, OMO has the tool. It is the tool to create cheap money conditions there. It is used to absorb excess liquid cash. As I told you that central bank comes in the open market to sell or purchase the securities. So whatever excess liquid cash is there, it can be absorbed easily by OMO. OMO is used to raise necessary funds to finance the developmental activities of the government. When the central bank will be selling the securities, it will have lots of funds which can be used for the development activities of the government. It is used to avoid disturbances in the money market created due to the movement of government funds. So OMO is also used to stabilize the money market disturbances. It is used for offsetting the inflow and outflow of gold. Another important point what OMO is used for. Further, it is used for insulating the internal credit structure from sudden and temporary changes in the balance of payments. Now, with the balance of payments, if your credit structure undergoes a little change, then OMO is used to stabilize it. It is used to avoid undue fluctuations in the prices of government securities. It may happen that the prices may go high or low, and those fluctuations are overrated or controlled by OMO. It is again used to avoid undue fluctuations in the yields of government securities. Here, yields means the interest. Hence, the open market operation is now considered as a principal instrument of monetary policy. Further, now we are discussing the common features between the bank rate and open market operations. See, they both, bank rate and open market operations, are objective and indiscriminatory in nature. They go by the aim for which they are made for. They are very well objective and indiscriminatory in nature. Both aim to control the volume of credit in the economy without any regard for the uses for which the credit is put. So here indiscriminatory, what we mean is that both of them aim. They will be definitely controlling the amount of credit in the economy, and they don't have to bother for which you are putting this credit to use. That is up to the government or the central bank how to use that money. But the aim, we are restricted, bank rate and OMO is just restricted for the aim for which they are drafted. Further, both the bank rate and OMO, they attempt to control the credit by influencing the cash reserves of the commercial banks. So the target of both these credit control measures is to influence, to affect the cash reserves of the commercial banks, with which the further step will be taken. Next, now we come to the major differences between the bank rate and OMO. See, the bank rate is considered as an indirect method. It is an indirect method to control the volume of credit. Bank rate first influences the cost and availability of credit to the commercial banks. The cost of credit available to commercial banks will be influenced, and thereby they will influence the cost of credit which they will be offering it to general public. Hence, it influences the willingness of the businessman to borrow and invest. If the credit which commercial bank is offering to the public is available at a low cost, then more businessmen will drive in to borrow more and invest more. So this is how the bank rate influences it. But it is an indirect method, it is considered. Now, OMO is considered a direct method. How come? It is more direct method since it controls the volume of credit by influencing the cash reserves of the commercial banks. So we come to the conclusion that if we relate both of them, comparative study may, we conclude that this is an indirect method and this is a direct method. Further, second point is the effect on the cash reserves. Bank rate does not produce immediate effect on the cash reserves of the commercial banks, and OMO affects the cash reserves of the commercial banks through the purchase and sale of securities. It is very clear. But here when I state that it does not produce immediate effect, I don't mean to say that it is neutral to the cash reserve. No, no, no. Definitely the cash reserves of the commercial banks will be affected by the bank rate. But now if we are tabulating the differences between the two, then we will consider it that bank rate, it does not produce immediate effect. No doubt it produces the effect on commercial banks. We all agree to it. And here we say that it definitely affects direct cash reserves of the commercial banks when the central bank comes to purchase and sell securities in the open market, right? Now comes the third point, as which is related to the flexibility. Bank rate is considered more flexible as compared to open market operations. Bank rate is applicable to narrower sector of the banking system, and hence it can be varied according to the requirement of the local situation. See, bank rate is related to what commercial banks will be charged and what they will be charging to the public, right? So the sector or the segment with which this bank rate deals is comparatively a narrow view. So it can be easily fixed, it can be easily flexible, it is more considered more flexible, right? But OMO is not flexible, it cannot be changed easily and quickly. So comparative study between these two considered that this is bank rate is considered more flexible and OMO is not flexible as compared to the bank rate. Now we come to the conclusion of today's article that both OMO and bank rate, they have their own merits and demerits. No single method, either the bank rate nor the OMO, they can produce effective results if they are used independently, right? Both should be judicially combined in the right proportion. So this is actually what is the monetary policy is all about, that we have to judicially, very thoughtful process ke sath, we have to combine both of them in the right proportion, when to use, how much to use each of them to achieve the objective of credit control effectively. So for a better credit control monitoring and the objective and aiming at the volume of credit in the economy, both these methods should go hand in hand and they should be used very judicially. So here we come to the end of the article. I hope you understood today's topic. Thank you for watching. Please like and subscribe to my channel. Do comment in the comment section if you have any doubts. Stay safe, stay blessed.